Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. And today my guest started by creating something called Left Field Investors because he wanted to connect with more limited partners because that's what he was interested in. Left Field Investors grew into PassivePockets. And my guest today is Jim Pfeifer. He's the co-host of PassivePockets with Paul Shannon, who was on only 4 episodes ago. Let's get to Jim. This is episode 236 of Zen and the Art of Real Estate Investing with my guest, Jim Pfeifer. Jim is the former founder and president and CEO of Left Field Investors, which is now PassivePockets, where Jim is the co-host of the PassivePockets podcast and a longtime investor in syndications as a limited partner. Jim, welcome to the show.
Thanks for having me, Jonathan. Happy to be here.
Yeah, I'm excited to talk to you. I had Paul on just a few episodes ago, and you guys have formed a great team at getting PassivePockets off the ground. So let's just go right into that. How long ago did you start Left Field Investors? Because this is really where you got your start in this end, correct?
Yeah, that is correct. And Left Field Investors was a pandemic baby, I guess is how you say it.
Yeah.
I had done active real estate investing and I was transitioning into passive. And I had started an active real estate group in Columbus, Ohio, where I met and just made a lot of great connections and did a lot of business with local people through those connections I made at the meetup. And so I thought, okay, now I'm getting into passive investing in syndications. I need a group, right? I need a community. So I wanted a smaller group. So I thought 12 people, we get together, have dinner once a month and talk about syndications. Yeah. Our first meeting was supposed to be March 18th, 2020. And in Ohio, that's when the world shut down, right? Yeah. So we never met in person. We went online. And, that first year, it was about creating a mastermind and trying to keep people away, right? Because so many people heard about this and thought, oh, I want to do this too. Yeah. And so we tried to keep it small because we were thinking it was a mastermind. And pretty quickly, by the end of 2020, we figured out that there's so much interest in building a community of passive investors who can work together to try to figure this out, right? It's a lot different than active investing. It's very difficult to vet operators, and these are long-term illiquid investments. There's a lot of complications. So eventually, we just said, you know what? This is something bigger than a mastermind, and we started a community. We got a website named it Left Field Investors, and we were off to the races serving limited partner investors.
Yeah, and the timing was really right for that because I kind of fell into something similar. This podcast actually was a creation out of the pandemic as well because we started doing meetups online for investors, which I had been doing in person before that. But they, as you said, they just started to get bigger and bigger. No one had anything else to do. We were doing like 5 or 6 meetups a week for different areas of the country. And then eventually I was like, why I could just start a podcast. So it's very interesting, the corollary there. But yeah, I think that was a time where people could sit back. They couldn't go out and actively look at as many properties. I remember for the first 6 months, like we barely were able to look at anything. I was wearing like gloves. When I look back at some of the stuff that I did to see properties then. So what was it about passive investing that led you to go from active to passive? Was it the normal that it's like, well, why do all this work when maybe I can kick back and relax a little bit more and trust others?
Yeah, it was partially that and partially that I wasn't good at being an active investor, right? It's asset management. Yeah. And I could do all the numbers. I thought I knew what I was doing. And what was happening was the market just kept going up, right? So anybody could make money in those days. I owned single family homes. I owned, multifamily up to a 22 unit, a couple 8 units, a 4 unit.
Wow. Okay.
And what I found out was I spent most of my time arguing with the property manager about evictions and other things. And I thought I was a passive investor, right?
Yeah.
I was passively investing into these units I was buying, and I had a property manager manage it. So that was passive.
Right.
But I was completely incorrect, right? My strategy didn't match what I was actually doing. And
Yeah.
so once I found syndications, I found my strength. And my strength, I think that if you're going to be active, you have to have an advantage over other people, right? You either need to be able to swing a hammer really good, or you need to know a particular market better than anyone else so you can find those advantages. I didn't have any advantages in the markets I was in. And what I realized is I can hire an asset manager who does that full time. That's their only job. And they're going to be much better at it than I am. And then it gives me the ability to diversify by market, by operator, by asset class, by debt structure, by so many different things that I'm not just stuck in one or two markets and one or two asset classes. So that's really when the light bulb went off that, hey, I can still be in real estate because I like real estate for a number of reasons, tax situation, the money you make, but I just wasn't good at operating the asset. And once I figured that out, I hire professional managers now, just like I do when I do my taxes. I have a professional do it.
Right.
When I want to drop a legal document, I don't do that myself anymore. I hire an attorney. So I also hire asset managers to manage my real estate investments.
Yeah, and I think that goes back to a lot of things that newer investors and investors over the last 10, 15 years are the confusion is around the term passive, because we know now that really the most passive are syndications, because you can't have control. I mean, that's the whole point. That's why we like them now. But I think as you thought, people thought that passive was being a landlord, but hiring property management.
Right.
And then you realize that managing the manager is really taking up all your time because they're not always on board with exactly what you want to do. And then as for what a lot of people, they have a regular job and now they have another job that actually takes up more time than their regular job. Was that the scenario that you ended up in with all those units?
Yeah, I mean, I was a full-time active investor, so I didn't have another job, but I didn't want a job that was arguing with my property manager about whether to evict people or not. And I knew that, what I wanted was cash flow because I'm a finance guy. I've been a finance guy forever and, Excel spreadsheets and all that. So I did all the numbers and I knew what the cash flow should be, but it never got there, right? The appreciation is what saved me, but the cash flow was never there because I wasn't willing to commit. Like on the 22 unit, I needed to evict a lot of people and rehab the place and just go all in like that, which I just didn't want to spend the capital on that because I'd looked at the numbers and thought, it should cash flow as is.
Yeah.
And so there's just a lot of things that I was missing and I didn't have the experience. And when I found syndication investing, it was just like, okay, this is for me. I can work to evaluate an operator and see how they do. I can use my community, which came later.
Yeah.
But once I found I can use my community for that, everything became a lot easier because, the biggest thing that you need to acquire as far as a skill set, I believe, if you're going to be a passive investor in syndications, is how do you vet an operator? And I went through several stages before I found, the best way that I found yet. And that will continue to evolve. But the first way I did was terrible. And then I got better and better and better.
Yeah.
And that's like the key skill you have to have.
Yeah, I wonder, just going back a little bit on your, when you were active, did you also find that being a landlord for me, it was uncomfortable? My dad was a landlord, so I grew up learning about landlording. He was too nice, so everyone was behind. And I came home for the first time to manage the properties at about 17 or 18. And he's like, well, some of these people are behind. I'm like, let's evict them. I'm going to evict them. He's like, okay, well, go talk to them. And then I went there. And of course I was a wimp. I felt bad. It's not as easy as people think to be like a hardcore landlord. People have real stories. Sometimes they're fake, but a lot of times they're real.
Yeah. And it's hard because even if they are real stories, you're running a business
Exactly.
and you can't give things away for free. Right. And I'm the same. There was a pregnant woman who had just lost her job to COVID and my property manager was going to evict her. And I said, no, that there's no reason to do that. And, these are hard times. We have to be, helping people. But that probably wasn't the right business decision, but it was the right decision for me. And so, I'd rather leave that in somebody else's hand who has systems and can be fair and objective because they're running a business, right? I don't like where you just go out and willy-nilly evict people or if someone loses a job. I want to give people chances. But at the same time, I'm running a business and it does get very complicated very quickly. And that's why I prefer to have a professional do it that manages the asset and manages the property manager who has to make those decisions.
Yeah, and like you said, during your active time, you were saying that none of the active projects was really what you felt was your total zone of genius. So it was like you're still going to be behind other people if the cash flow is not catching up. But then for me, it's the same for me because I only started investing in syndications last year at 52, and it was like, wait, as you were saying, this is all these people do.
Yeah.
So why have I been doing all this work all these years when I can just trust experts? But to your point, do the vetting and get better at the vetting so you don't make a mistake that a lot of people did.
Right. And a good example, I think, is my 22 unit. When I sold it to a friend of mine who did this for a living, right? He was flipping homes and also rehabbing apartments. And I sold it to him knowing that he would probably double the value in less than a year. Right. I had already more than doubled it. So I was happy. And I sold it to him knowing that I just didn't have the energy, the time, or the resources to do what he could do.
Yeah.
And sure enough, in about 9 months, he doubled the value of that property. And so some people look at that as leaving money on the table. I look at it as he got me out of a tight spot where I wasn't comfortable. I wasn't happy with it. It was a pain in the butt. I made a bunch of money on it. Now let's sell it to him and he can make a bunch of money on it. And it's a win-win. That's kind of how I looked at it.
Yeah, I love that. I think of it the same way. Sometimes I've done well on an initial flip and then, 4 years later, the appreciation in New Jersey is so insane that the next person's made 200 and they're like, oh, you could have kept it. I'm like, I didn't want to keep it. I already flipped it. What am I going to do? Like rent it out? I didn't want to rent it out. So, I think those are smart choices. And it's another thing people have to realize now that trading properties can really help you, especially if you want to change the way that your portfolio looks. I think previous to passive investing becoming more popular, people were so obsessed with doors, they still are, that they were hanging on to doors just because it sounded cool to have, 22 units and then realize I hate the 22 units. Well, if you hate it, why do you have it? Did you get to that point with those properties where it's like, I just don't enjoy this?
Oh, yeah, absolutely. You go to any meetup of active investors, and I haven't been to one in years, but at that time, the first question was, what's your name? The second question is how many units,
doors?
Right?
And
doors. And so I'm like, well, I was up to 40 doors, but my cash flow wasn't where it was supposed to be. Nothing was working how I thought it was supposed to. I had all kinds of problems and stress and all of that. And, I'm not going to say it all went away when I switched to passive, but most of it did, especially at that time in the market where you were investing in syndications, in 2020, 2021. Stuff was going full cycle in 2 years and you were doubling your money. So it was like, okay, I could do this active stuff that I wasn't good at, or, at the time I thought, wow, I'm a genius. I'm doing all this stuff and making all this money. And of course it got a lot more difficult because those were really, really good times for that type of investing.
Yeah. And I think that kind of gave a little bit of like overdone state to what people were doing. They thought it was going to go on forever because it was a 2-year cycle. And now it's like, well, you're not getting close to a 2-year cycle. Like we're actually going to do, it's going to say 5 and it's going to maybe be 8, depending on what happens. And that's something that I think we've seen people have to adjust to. Have you had to adjust to that as an LP for some of your investments that you thought might cycle earlier? And now just because of what we've gone through, they're going to cycle a little later or end up in some other type of distress?
Yeah, absolutely. It changes everything, right? Because the pro formas are always 5 years. And for a while, it was going to be 2 or 3 years, maybe 4. And hardly any of them got to 5 years. And now those same deals are going to be 7, 8, 9 years. Right now, a lot of the annual reports are coming out from how things did in 2024. And some of these are investments I did in 2019, 2020, which you would expect them to be talking about sales. And in those reports, they are talking about, hey, we're going to sell this, but it might not be for 3 or 4 years until market conditions improve. And to be honest, that's really where it should have always been, right? It should be a 5 to 10 year hold to complete the business plan, or it could be. It doesn't have to be, but just flipping apartments from one person to the next, you are making money, but is that really productive, right? Where I'm going to go, or one operator is going to go in and rehab 20% of the units or 80% and then save some for the next person, so that then you're kind of manufacturing equity, which is good, but that's not the purpose of real estate investing, right? The purpose of real estate investing is to provide a service to people, which is a home to live in or a box to put in your junk, right? And so those are the kind of things that I think about. It's more of a slow and steady thing, right? It isn't a get rich scheme. It's a build wealth slowly scheme. And that's how it should be thought of. And for a few years there, we were in the get rich scheme area.
Yeah, because at that time it almost seemed like more liquid of an asset just because you get your money back to do something with much quicker. But now everybody has to realize, who's looking at it, like, it's not liquid. Like, you can't do anything to get your money out. So buckle up. Even if you're okay with 5 years, what if it's more? The way that I look at it, the same way I look at what I put in index funds. I put money in index funds that I don't need. So it can go through the cycles of the market. It has nothing to do with me. I don't need to take that money, barring some catastrophe. And I think the same way when I'm investing in syndications. Do you think that that's a smart way for people who are looking now to invest passively in syndications for the first time to think about it as like, hey, I can't touch that money, so let's just let it churn and see what happens.
Yeah, and I think that was probably one of the biggest mistakes I made in syndication investing, was not understanding liquidity.
Yeah.
And now I am hyper focused on it, right? Because what I did, since everything was going 2 or 3 years, I kind of went all in and put a lot of capital in this, thinking, well, in 2 or 3 years, I'll get that, it'll double and I'll get it back. And so that really changed. And so you really need to think about liquidity. And, I usually add a few years. If they say it's a 5-year hold, now I'm thinking, okay, it's going to be a 7, where before, if it was a 5-year hold, I'd think, it'll be 3. Yeah. Right. And so it's a huge mindset shift. And then one of the biggest things that you have to tackle then, if you're going to do this syndication investing, is what do you do with your cash, right? Cash drag is a real thing. Now it's better now because you can put cash in, a money market and make 4%. So it's not just earning nothing, but at the same time, because these deals are going longer, you're going to have to hold more cash in those places. And so I think finding safe places for that money, for me, I have a few places I put it. I put it in a money market. I put some of it in high cash value life insurance.
Yeah.
I put some of it in the market, which I was a financial advisor. I've always been a stock market guy. I got completely out of that. But now that's where I put some of my liquid money, is in probably index funds and things like that.
Yeah.
So because that is easy to access if I need it, right? So I think managing your liquidity is a huge part of this, and it's much more important than it was, 3 or 4 years ago.
Yeah, and that goes to diversification too. And I think, financial analysts rightfully have gotten a bad rap from real estate investors because their job is to not invest in real estate because they're not getting a commission. But now I think there's a lot more who understand, like, hey, if we really want to help people be diversified, let's allow them to have their real estate and then counsel them on what to do with the other money. So you can have some in index funds, which you can get out, but it's a little bit less liquid than just investing like in E-Trade. Like, I put some that I just like to play around with on my own just to see what I can do with limited amounts of money. But I think that, real estate's so interesting because, especially in the syndication space, you were saying earlier that it allows you to invest in asset classes and like geographical locations that you would never have access to. That's what I've found really interesting. So far, it's just been multifamily for me. But again, I don't want to be a multifamily operator. It sounds terrible. But now I'm getting into geographical areas that I've always been interested in that I don't really want to buy just one house in. It doesn't make sense. Right. So that, I think, is kind of the fun for syndication investors, that you can follow along monthly. You just have to also accept, like, you can't, you really have nothing to say. Just read the documents and ask good questions, and learn. You can learn about that whole market just by being an LP.
Yeah, and there's differences, right? It's, if you're a stock market investor, you can't call up Tim Cook and say, hey, how's my Apple investment going, right?
Yeah, I'm not sure about the direction you're going with the new iPhone, Tim. I'm sure I'll take that call.
Exactly, right? But I can call up the operator of a syndication I've invested in and say, hey, what's going on here?
Yeah.
And actually talk to the principal. I don't have to just talk to the investor relations person. I can talk to the main person and find out what's going on. So you don't have control, but you have access. And I think that's a big deal. And then you mentioned diversification. I mean, even if you're just a multifamily investor, you get diversification by operator.
Yeah.
You get it by market. And then, I like to diversify by asset class. And you can, there's a ton of different types of investments that you can get into that are different than multifamily.
Yeah.
And so what happens is multifamily, that's where there's been some difficulties, right? Especially with the loans and things like that. Well, if you're in industrial or in self-storage, they still have the same interest rate concerns, but they're not as severe. So, by the fact of just diversifying into another asset class, I'm just protecting myself. So I think diversification is one of the big benefits of syndication investing.
Yeah, and I think there's a lot of options out there. So when something does go full cycle, you have opportunity to 1031 into another option, which could be another asset class. Oh, like I've been interested in this. You can do your due diligence in advance to really see what's out there so you know where you want to put the money.
Yeah, and I would even argue that 1031 isn't really completely necessary, and it's difficult to do in syndications because then you have to find a specific operator. But when I sold all of our active real estate, I didn't do a standard 1031. I went to my accountant and I said, hey, I'm selling all this active real estate. I'm going to have a lot of gain. And, what do I do? And he said, well, there's a couple things you could do. Number one, you just made a bunch of money. You could suck it up and pay the taxes. And I thought, well, that's not my favorite option. What's option number two?
Yeah.
And he said you could do a lazy 1031, which is basically if you invest the gains in a new syndication and you get that, and at the time bonus depreciation was 100%, so that makes a difference. You can use all that new loss to offset the old gain if you do it in the same calendar year. And even as bonus depreciation decreases, you can still do that. And so, for how I do it, I don't pay much tax on the real estate holdings, and it shocks people, but that's one of the big benefits of real estate. And to be able to do it without having to jump through the hoops of a 1031, but getting a similar result is another huge benefit.
Yeah, and that goes to, again, working with experts, because your regular just CPA who's doing, Randy's taxes and Bob's taxes and Cheryl, they may not know the intricacies of what you're doing with real estate. And I think, that goes to what we were saying. When you're looking for operators, you want to make sure you understand their track record. And same with the other people that are going to assist you, because if you make good investments and you don't have a good team helping you in the financial, and your investments aren't going to be as good as you thought they were.
Absolutely. And that's why when I use an accountant, a CPA, to do my taxes, which I do, I found someone who does real estate.
Yeah.
Right. And he's an active real estate investor himself. So I had to kind of explain a little bit about the syndication world to him. He already knew a little bit, but it's important to find these experts that will help you, right? If you just go to a standard CPA and you're a real estate person, as you said, that person's going to miss some stuff because they're just the standard CPA. It's the same if you have a financial advisor. You mentioned it. You need to find a financial advisor who understands and allows you to invest in real estate, right? When they see a chunk of the money going from them to real estate, there's a couple of reasons why they don't like that. One, they lose the commission on that. But two, they're also not licensed to recommend or understand real estate.
Yeah.
So you need someone who understands, hey, part of my money is going to go over to this real estate stuff, and I need you to support that. But also I need you to include that in your modeling because it's part of my overall portfolio.
Yeah.
And I think there are more financial advisors who do that, but it is still really, really hard to find someone who can do that and do a good job of it.
Yeah, that was a real hard find for me, because I worked with people from Merrill Lynch for years, and they were always just discouraging real estate. And all I did was real estate. I had other investments. So they weren't doing nothing. They had money to invest and make commission off. But I've been happy for the last several years, because it's just been, the company is just like, yeah, this is the money that you keep in real estate. Again, like you were saying, we're going to keep it into your modeling and your net worth and what your future value is and what type of income you want. But they understand that that's part of what I like to do. But they help me keep it diversified by not being so tight. I don't want to hire someone who tells me not to do anything unless it's advice,
Right.
Like real advice, not, advice based on, hey, I'm going to lose some money on this.
Exactly. And that's why, all these things we're talking about, it's about trust, right? And finding quality people. And that's why, I talk about the power of community. And that's why, we started Left Field Investors and now we're at PassivePockets. But the purpose of it is to share, right, with other people. Hey, who are the best operators out there? Who have you learned to trust by their results? Who's a financial advisor that will include my real estate in their analysis? Who's a good tax person that understands syndication investing? And those are things that it's really hard to find those people. And, I've been through 3 or 4 CPAs. I've been through some financial advisors. I was one myself, and I still couldn't find the right people. So I think that's why I think if you're going to be a syndication investor, one of the most important things you can do is be part of a community, because as we mentioned, these are long-term, illiquid investments completely out of your control. So if you want to test out an operator, right, that means the deal has to go full cycle. We were talking, it used to be 3 years, then 5, now it's maybe 7. So you're going to make one investment and wait 7 years and think, okay, yeah, this worked out, I'll do another one. that's a really slow way to build wealth. So what's the shortcut? It's talking to other people who've already invested with the operator and have experience.
Yeah, and I think it just goes to, like, if you really want to get the best recommendation and you have two choices, you can go on Google or ChatGPT, or you can talk to somebody who's been in the space for years and they can just tell you who to go to. I'm going with the second one every time. I love personal recommendations, and I prefer, I mean, my regular on-market business only works from recommendations. I don't really want cold leads. They don't make any sense to me because they're there for a reason. You're just trying to get a deal. There's not a deal in this scenario. You can't call me, hey, is there anyone who's going to give me a discount on a syndication? Like, that's
Right.
not how it works. Like, you want the best operator.
It isn't, but one thing you can get through many of these communities is you can get better terms, right?
Yeah.
So instead of a 7% pref with an 80 or a 70-30 split, you're getting a 80-20 split with an 8% pref because they're buying in bulk effectively from a community. So there's lots of reasons why communities are super helpful, but it's just that this is a hard thing to really wrap your head around and find quality. You're wiring somebody $50,000.
Yeah.
That's a big deal, right? And it's not wiring it to the bank that is going to give you a loan or wire it to the person you're buying the property from. You're wiring it to some guy you talked to for 30 minutes, right? Because you heard him on a podcast, and now he's going to take your money and operate this business that you're part of now, right? That's a huge decision, and it is way out of your control. So that you have to get comfortable with that.
Yeah, I mean, especially for a lot of us who were active are control freaks. And then, the reason why I like passive investing and syndications is because there's nothing I can do. It's actually like a great like kryptonite for me on purpose. Like, I want it, so I can't. There's nothing I can do. I can't change the outcome. Even if I'm annoying, it doesn't change the investment. So it's helping me learn to release the control factor, because I don't really like to be active myself. I like flipping, but I don't want to do like a ton of flips. I just do one when I feel like it. There's when the deal is available, but I'm not on site. I have a buffer and a project manager for that as well. Just like I want someone who's in control of it. I don't want to be in the day-to-day operations of that.
And I think part of that is really looking, at yourself and figuring out, what do I want and what am I good at and what can I live with, right?
Yeah.
For me, if I find someone that I know, like, and trust who is better at, multifamily operations than I am, which is not hard to find, then, I can feel comfortable giving them control. Now, I'm going to monitor them. I'm going to read the reports. I'm going to call them up if I see things going sideways. But you're right. I don't really have any control, but I have to get comfortable with that. For other people, maybe they aren't as comfortable, so it takes them longer, and maybe they're also doing flips or also doing other things. It's just about finding your comfort level. But I really haven't found better investments than real estate. And, if you aren't, as I said earlier, if you're not good at swinging a hammer, or you don't know a market, or you have a full-time W-2 job, or a million other reasons, this type of investing is definitely something that people should look at.
Hey, it's Jonathan. I hope you're enjoying this episode with Jim Pfeifer. Remember, we had his co-host Paul Shannon on only 4 episodes ago. If you want to get in on this fun, go to PassivePockets.com. Right in the top, there's something that says Start 7-Day Free Trial. So you can get 7 days free access to Passive Pockets, connect with other LPs, find and vet GPs. You can get into the syndication game. Let's get back to Jim. So for you as an LP investor in syndications, do you prefer one-off syndications, or do you also invest in funds where they have a little more leeway to pick the properties?
I do both. And to be honest, I haven't figured out which I like better. That's a tough one, because, I like the fund because it gives the operator, if I really know the operator and trust them, then the fund is great because it gives them more leeway. It gives them more power. They can go and just, pay all cash for a building and finance it later, so they're more competitive. There's all kinds of advantages there. But especially if I don't know them very well, or it's a first time investment, I would prefer an individual syndication, because then I can look at the deal, I can analyze it, I can, ask them a bunch of questions about that specific deal. So I think for me, I would prefer, especially with new people or people that I don't know that I'm investing with, I'd prefer to have a single asset syndication. Now, for people that I've known for years or I'm comfortable with, let's do a fund, and that's even more hands off, right? Because then I'm not even, there's nothing to analyze.
Yeah,
right?
exactly. You're just hoping for the best. And the returns are different. You're going to get more structured returns in the fund than you will in the syndication. I've only invested in single property syndication so far, but I like what you said because I can see myself being open to a fund later with operators that I've worked with and trust, where it's like I want to give them a little more leeway. And sometimes a fund is diversified in and of itself, because if you have 3 or 4 deals in there and one doesn't go well, your whole thing's not shot like it could be with a lot of deals that are going on in just single property syndications now.
Yeah, and it's also a function of the market, right? I mean, before interest rate, well, I guess in 17, 18, and 19, there almost not very many people were doing funds, right? But as the market really heated up, then people got, okay, let's do funds because everything's more competitive and it's an easier way to buy properties. But now you're seeing people are starting again, because the market's in the place that it is. People are starting again to do more individual syndication. So it's kind of an ebb and flow with the market as well. Sometimes you don't have a choice. There was an operator who I really, really liked, and the only way they were doing a fund, and that was it. So, you don't have choices sometimes. And that's part of this type of investing as well. You lose control, and sometimes you lose a little bit of choice.
Yeah, and just for the listeners, I mean, personally, I like the single property syndication because I can pull it up on Google. I can look at it. I can, as you were saying before, I can look through the PDF. Like, it's a tangible asset that I could go see if I wanted to. And that makes me feel like a little bit more in control, even though I can't change anything. And I think I can see, again, adjusting to funds. But I think for newer investors who are trying to figure out, hey, is this the right thing for me? There is a little bit of balance where at least that's the property. You can see it. You can drive by it if you were in the area and see that it actually exists, instead of just waiting for things to fall into the bucket.
Yeah, and there's also other options for funds, right? I mean, most of these are going to be open 6 months to a year.
Yeah.
And so if it's the first time you're uncomfortable with a fund, or first time with an operator, don't invest the first day the fund opens.
Right.
Wait until they have 3 or 4 properties. Then you can ask for the details, the pro formas for those specific properties.
Yeah.
You can analyze those like a single asset and say, okay, they're in 3 properties so far, and each one of these are, thumbs up. They check all the boxes. I looked at them. They're fine. Okay, I'm going to assume the other 10 properties they're putting in here are going to be similar to that. So if you invest at the latter end, you might give up a little bit of return, but you might gain some comfortability in the analysis.
Yeah, that's great advice, because then you get a kind of preview of what's in there, get comfortable with it, and then you still have a little bit of that, hey, well, let's see what they do. But that goes back to the trust factor. I think one of the most important things that I've talked about with so many syndicators and LPs, GPs, everybody who's been involved, is the vetting of the operator. Most of us have read Brian Burke's book, Hands Off Investor, and taken his operator first. How did you approach it in the beginning, and then what changed? Because of all the people I've brought on who are now very deep into syndications, they all have horror stories of how little due diligence they did in the beginning.
Oh, you want to talk about how little due diligence? Here we go. So I've been through, I guess, the 3 stages of operator evaluations is kind of how I look at it. When I was first getting into syndication investing, I thought I was going to be a syndicator. So I went to a conference, and they had both LPs and GPs there. And this was a big deal for me because I'd always worked in corporate America, where when I had to go on a business trip, I just take out my corporate Amex and pay for everything, right? And so I paid out of my pocket the flight and the conference fee and the hotel. And this was a big change. So it was a big commitment for me to spend all this money on this wild real estate stuff I was doing. So I got there, and I had an old IRA that I'd rolled over into a self-directed IRA. And so I had money to spend. And I thought, okay, all these people, all these GPs are here at this conference. And I was 5 minutes into the conference when I figured out, oh, I'm an LP, not a GP, right? Just based on what they're talking about.
Yeah.
And so what I did was I just started walking around meeting GPs and saying, hey, can I invest with you? Here's some money, right? I didn't, the vetting was.
That's very common though for first time, because you kind of get charged up to do it, and then you just want to do it. The money's sitting there, you're ready to go. Right.
And it was money that I knew I couldn't use for a long time because it's locked up with the government and all that. But the real mistake I made was I assumed that every GP who was at the conference must be a quality GP. Otherwise, why would they? Why would they be invited?
Right.
And now, of course, I know they weren't.
They paid.
What invited them was the cash they paid. Right. So that was a really bad way to vet an operator. And one of those deals is one of my worst ever. couple of them are okay. And I think I got one good deal out of that, but I did get a lot of good relationships that turned into good stuff. So going to a conference, fantastic. It's a great way to meet operators face to face. Even though we do everything by Zoom and all this now, meeting someone face to face is really a better way to get a measure of them.
Yeah.
So do that, but don't just invest in somebody because they're at the conference. Wrong way to do it. That was a bad idea. So the next evolution was, okay, I'm going to go to Podcast University, right? That's where I'm going to listen to all these podcasts, and an operator will be on the podcast, and I'll listen to him for 30 minutes, an hour on the podcast, and then I'll call him up and I'll talk to him, and I'll get a 30-minute slot and I'll talk to him and ask him all my questions. And then I have to decide, okay, I've listened to him on a podcast. I've talked to him for 30 minutes. Am I going to wire him $100,000 for this investment? And while that is much better than the first version, you can't really tell, are they just a really good podcaster / marketer?
Yeah.
Or are they a good operator, or are they both, right? So I had better results with that, but it's still, there were some hits and there were some misses, because you can't really evaluate someone, their track record, based on what they're saying on a podcast and then a 30-minute conversation you have with them. And, sometimes I'd ask for, well, can you give me some investors that I can talk to that have invested with you? Well, that's great, but who are they going to give you? Yeah. They're going to give you their favorites, right?
Of course, yeah.
They're not going to give you the person who had a bad experience. And so you're talking to all these cheerleaders, which is great. At least they have some.
Yeah.
And that's when, after I did that for a while, I finally figured out the best way so far to vet operators. And that is, now I only invest with a new operator if they're recommended to me by someone in my community who I know, like, and trust, who is already invested with that operator. Now, invested, that's it could be, they don't have to go full cycle necessarily, but they've sent them money, and they know that when they wire the money gets there. That's one, right? Yeah. They know that you're going to get the guy or gal promises monthly or quarterly reports, and they've received them, right? The distributions that they've said would come have come, or have had good reasons why they didn't come. Yeah. So all of these things, I can't, without knowing someone that's actually invested with them, I can't check all of these things. Now, it isn't perfect, but what it does is I'm starting 100 steps ahead of when I was just listening to a guy on a podcast, and probably 1,000 steps ahead when I go to a conference and start throwing money around, right? So this is the new way I do it. And that's why I think community is so important, to belong to a community or several of people that you can talk to about this, share ideas, share information with. Because again, we've said it before, long-term, right? Out of your control, illiquid. That's what these are. And so the most important thing you could probably do is invest with a quality operator. Because as people say, you can get a bad deal can be made okay by an operator, but man, a good deal can really go down the toilet with a bad operator. Yeah. And so you really want to concentrate first on finding quality people to work with. And I have not found a better way than networking within a community. And if somebody has a better way, I'm all ears. But that's the top for me right now.
Yeah, I'm sure someone will come up with some ridiculous AI algorithm to determine, but I'll pass on that as well, because it doesn't have the nuance of the relationship, which I do think is really important too. And you get an idea of someone on a podcast, but then, like you said, you really have to, are they marketing? Or is it genuine? And you can find that out in real life. And for me, I particularly don't like to get pitched. I just want information. I don't really want a whole, follow-up email plan, because it just feels like that's impersonal to me. I want someone who's going to give me all the information. Maybe they check back in and see how it's going. But if I want to do it, I'll do it. I don't want to feel like, once I feel pressured, it's always a hard no for me.
Yeah. And I think, there's still, you can't just join a community, ask everybody in the community, hey, who's your favorite operator? And then just start throwing money around, right? You still
it might not be a fit for you, right? Yeah.
Right. You still need to do the vetting. And so, part of that for me is, I'm a little bit of a hassle as an investor. I'm a little bit of a pain in the butt. And I want them to know that ahead of time, because I ask a lot of questions. Yeah. And so, when I'm working with a new operator, they'll send me a deal and I'll have some questions, right? And we have a deal analyzer at PassivePockets that kind of just pops up red flags based on the financials, right? So I'll run it through that, and all the red flags, then I'll compose an email to the operator and say, hey, here's some things I have some questions about. Maybe it's 5, 6, 10 questions, whatever. And then this is a test. As much as I want the information, it's a test.
Yeah.
And what I'm testing is how quickly do you respond? I expect something within a reasonable amount of time, 24 hours or a reply saying, I'll get to you next week. But I also want quality answers, right? In the past, I've gotten someone say, well, all that information is in the webinar. And my response is, I know, I watched the webinar. I want to make sure you know your deal.
Yeah.
And, that's probably, if they tell me that, that's probably a pass because I want someone who's going to respond. And so when they respond to that email with all those answers, even if they've answered every question and I'm good and I have nothing else, I always reply with more questions. Because again, I want to let them know, hey, I'm really interested in this and I might be a little bit of a hassle. Can you handle it?
Yeah.
Right. And so I'll always ask follow-up questions to make sure that they're willing to engage. And some of them will call me up and say, hey, it's easier to have this conversation on the phone. Totally fine with that. But just being able to I want to make sure that they're going to answer questions. Because I'll tell you one thing. If they won't answer your questions before you've given them your money,
good
what
luck.
do you think they're going to do once they have your check?
See you in 7 to 10 years, and it's not going to be as exciting as you thought. That's really good advice. And I think it's always a vetting mechanism, and GPs should be vetting to see what kind of avatar they're looking for as well. But I feel more comfortable getting the answers that I want as well. And I think it's fair to test someone and then make a decision based on that, because again, it's your money that you're going to send and you really want to see. I personally think that the best GPs understand and take into account, like, wow, these are good questions. These are things that other people are going to ask. And these are things that maybe we should address in the documents that we're missing. Because I think of that, like, it's a weird corollary, but I always liken this part that we're talking about now to short-term rentals. When people leave a review, a lot of times the people just get mad. The owner gets mad instead of like, well, actually the review was bad because you were missing something. So if you're missing something and then you take it into account and then you put it in the description, you're going to save yourself a bad review. Now, these GPs, if they're taking your, what you were saying is, maybe these are aggravating questions, it could help them dramatically uplift and adjust their material by explaining something that a lot more people are going to ask.
Yeah, and we've done some of that at PassivePockets. We do deal reviews.
Yeah, I love it.
Yeah, where we do a webinar and we get an operator on. They have about 10 minutes to pitch their deal. Now, everybody watches the webinar, the standard pitch webinar and reads all the docs beforehand, or they're supposed to. So they already know a little bit about the deal. But the operator will kind of pitch the deal, and then we'll have 50. We have usually three experienced LPs, and we'll just grill the operator for 15 minutes. And then we'll say goodbye to the operator, and the three of us will sit around and talk about the deal. Yeah. And it's just a great way to learn what experienced experienced LPs, what questions they're asking. Because some of it isn't intuitive, and we're not trying to, we're not playing gotcha, like trying to find stuff, but we're trying to ask the tough questions so that people understand you're allowed to ask these questions. If someone's asking you for $50,000 or $100,000, you can ask them whatever you want to ask them. And if they don't want to answer, you can go on to the next one. There's plenty of operators, right? And, there's some operators who don't like answering the questions because they already have all the investors they need and maybe they're not looking for new investors. Okay, that's fine. Don't answer my questions. Or somebody that's new and just thinks, well, I'll get money from somebody else. Well, then we're not a match. Like you said, it's a two-way street, right? I have to be comfortable with the operator, but they also have to be comfortable with me because we are about to sign documents that put us in business together, where they're forming an LLC and I am one of the owners of that LLC. So both of us want to be able to understand each other and know that we're a fit. And the other thing that I've recently added to my vetting is I'm not going to do an investment or do business with somebody that I don't like, right? Because again, if something goes wrong or something goes good, I'm going to have to get on the phone with this person and chat with them because we are business owners together.
Yeah.
And I don't want to do business with somebody where I'm not going to call them because I'm like, oh, that guy's a jerk. I don't want to deal with them.
Yeah.
Right. There's plenty of people out there. So if you don't like the person, go find somebody that you do. It's much better to do business with people that you can like and tolerate than someone that you dread having the conversation with, whether it's good or bad.
Yeah, I agree. All right, let's talk about PassivePockets a little, because I know you guys transitioned your original company to PassivePockets. But what does PassivePockets offer now to the Bigger Pockets community? Because it's still pretty new. I think only maybe six months or less than a year in. And I think there's a lot of people. I've obviously been on Bigger Pockets for years and years, and I think it's interesting. People, what can they get from PassivePockets as a member, and then what does the trial and then the membership do?
Yeah, so the membership, it's completely separate from Bigger Pockets. It's a different website, a different community, but we do have a lot of crossover,
Yeah.
right? A lot of our members are members of both. And what you get with the community is a lot of what we've been talking about. So there's a forum where you can interact with other investors, and we have a lot of people, hey, have you ever heard of ABC Operator? And then other people will comment. We have several different interesting, I think, categories. Like we have the red flag sponsor category where people post, hey, here's what happened. I had a really bad experience with this operator. Here's why. And then other people can comment on it. We have the same thing for good operators. We have reviews. So you can go there and look, does this operator have 5 stars, 4 stars, whatever? And people can comment on it. In the forum, you can ask any type of question and you'll get lots of answers. I mentioned we have the deal webinars. We also have some investing tools like the deal analyzer I talked about. There's a sponsor, like a screener. So questions you should ask a sponsor the first time. So there's just a lot of content, and we're constantly developing more. And you get a free trial, which is nice. So you have 7 days to kind of test out the site and see if it's a fit. And what I tell people that there's not a lot, but there's several different investment communities out there for syndication investors. And I think one of the critical things is that you find one where the culture of that community fits your personality.
Yeah.
Now, that might be PassivePockets. I'm obviously biased. I think it's the best community out there. But if you're not comfortable there, find somewhere where you are, because there's a lot of different types of operator or communities. Then another thing that we do is we have an annual meetup, and this one is coming up in May. It's in Columbus, Ohio, where we get 100 to 150 LP investors. We also have GPs come, and it's kind of a unique meetup where we do a lot of networking. We facilitate networking. So you're constantly meeting other LPs, you're meeting operators, and you get to meet not one-on-one, but small group time with each operator that's there, so you can learn about them and all of that. So there's a ton of stuff you can do at PassivePockets. And again, if you're going to do syndication investing, I really, really think you got to be part of a community. PassivePockets is a great place to start.
Yeah, I was looking at the event, and it's nice because it's a smaller thing. It's not a huge conference. It's really going to be accessible and able to talk to really a ton of people, get a bunch of information in a short amount of time. So yeah, that looks really good. I'm going to try to make my way into that as well. Awesome. Well, Jim, it's been a pleasure. I really appreciate the time, and congratulations to you and Paul on doing PassivePockets together as the co-hosts of the podcast. That seems to be going well already as well. So I appreciate you spending the time with me.
Thanks for having me on. It was a pleasure.
Yeah. All right. That was Jim Pfeifer. He's the co-host of the PassivePockets podcast. He started off as Left Field Investors. Now that is PassivePockets. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And it's Mike Cassette, who's a broker owner of a brokerage in Austin, Texas, but he's also an investor who has done it. So when we talk about investing, we talk about Mike's investment, we talk about how he helps his clients, and also what you should look for if you are a new investor looking to find an agent. We go all through it, investing, agent side, how to find an agent. Stay tuned, next episode with Mike.